Right, hi guys, good morning. This is Oyen. I'm just going to, as promised, make a couple of videos to tie up Chapter 3 from the textbook that were the Kaplan textbook. Chapter 3, we sort of worked and discussed property income and quite a bit to do with property income, but there was also this little bit about savings and investments. I mean, it is important actually. It's a big part of it. So let's quickly flick through that, and then I'll go on to Chapter 4. Where we'll be discussing employment income. But let's quickly finish savings and investments. Okay, let's go. So, what are we talking about here when we talk about savings income? We are, see my pen's working, brilliant. Good. So when we talk about savings income, we're really fundamentally talking about interest, if you like. And when we say, you have people that have money in the bank, savings in your savings account, or your building society, that's what we're talking about here. And this money is received gross now. So typically the interest that your bank will give you will arrive fully as a full amount, and then you will have to, on your self-assessment return, if you like, pay this off to HMRC. In reality, it doesn't quite work that way, but this is the assumption you must make. Other examples of savings income. In class, if you remember, I said that we had this national savings and income, and they started off just making certificate accounts, and those were tax-free, but they also now make other products. So the other products from their investment accounts, their direct saver accounts, any interest from there is taxable. Now, gilt-edged securities are government bonds, if you like, tied to inflation. So if you buy any government bonds, any treasury stock, whatever it is, any government stock, basically if you lend money to the government and the government pay you back an interest, that interest is taxable. And finally, if you buy any stock, debenture stock, if you like, lending money, if you like, to quoted companies, and you can do this on the market, you can go and lend money to Tesco's, whoever. Any interest you receive, I mean, in effect, it is a loan. Any interest you receive is also recognized as savings income. As you can imagine, if you actually buy the shares, you will receive a dividend, and that will be the subject of our next, if you like, set of videos where we talk about dividend income. But for now, we're talking about savings income. Okay, and this is purely taxed on receipt, so it's when you receive it, as opposed to when we discussed property income, which was accrued, and then you would knock off any bad debts because if you hadn't received something in that year. But income, savings income, is pretty much based on what you receive. And the rules are pretty much similar. I mean, if you have that in your mind, 20, 40, and 45%. I mean, there are a few quirks we'll look at on the next few slides, but this is the general agreement. And this is how, if you've studied some personal tax before, you will remember it. Savings income has always been taxed at 20%, 40%, and 45%. I know I'll say it in the slides again, but we always first of all deal with non-savings income. So this has been, if you like, we're talking about taxable income now. We're talking about if you're 0 to 32,000. Within this band, you will first of all deal with your non-savings, and then whatever's left, you start then when you've dealt with your non-savings, you start dealing with your savings. And so any savings that are left that fall in this band, if you like, are taxed at 20%. That's what this is really saying. And then you carry on, and then you deal with the others at the higher rates. Okay, right, let's carry on. Now, the first quirk that I've put here, I just put quirk to maybe sort of stimulate some way of remembering the oddity of it, is this idea of this year. This is the first year it's been introduced. When I say the first year, Finance Act 16, this idea of a starting rate. And now this is the fundamentals really here as to, if you think about it, we didn't have this starting rate, and what would happen is, as you can imagine, what people are saving money, and the argument is, why would they want to save money and pay tax on it as well? So they would, of course, have to look for more tax efficient means, if you like ISAs and things like that. So and then this kind of led, if you like, to some element of tax avoidance. And so the government just thought, you know what, scrap that. Let's just allow people enjoy this benefit of a 0% if their savings income falls into the first 5,000 of taxable income. So what am I saying here? Taxable income is if you like, you've dealt with your, well, I should really say after, yes, first 5,000 taxable income. So, but remember that your personal allowance comes off your non-savings income first. So imagine, we'll do a couple of examples to show you. But the key argument here is that if you don't have very much income, employment or trading income, and you have some savings income, you could get this benefit of 5,000 being taxed at 0% before everything else continues to happen. And again, like I say, it's really to do with people that don't have a lot of income. We'll see an example in a second. A lot of this really needs good examples. So this is the first example. This is what I'm trying to say. So imagine Jim has employment income of 11,000, and he also has his bank interest of 2,500. What would be his income tax liability? So first of all, he has this 11,000 here, and then he has a personal allowance. So I mean, again, we'll look at tables, but like I said, if you remember, the tables are so helpful. We have total, non-savings, and savings. So he has 11,000, and we have the personal allowance, and then we have 2,500 here. So the personal allowance is always used up again. So let's just make a step. I'll put that here, right? And this is, if you like, 13,500, 11,000. So you can see now that what we have here is taxable income of 2,500. So now, of course, the personal allowance is always used, if you remember from the last class, first of all, against his non-savings income. So he has no non-savings income. And where I was going, the earlier example that I gave, that the first 5,000, if he has savings income that falls in the first 5,000 of taxable income, and the first 5,000 of taxable income is anything after the personal allowance has been deducted. And all this 2,500 falls in that bracket. So this 2,500 can be taxed at 0%. And we'll see an example when it's not quite fully available. But that's the general idea. And so I say that here. This means that the first 5,000 can be taxed at 0%, without, if you like, giving him a income tax liability of 0%, which was not the case before. Before, he would be taxed at 20%. This 2,500 would be taxed at 20%, but now, because of the starting rate, he would benefit from this. Now, I give you a next example. To be fair, just to mention this, these are coming from your textbook. I'm currently on, just in case you want to follow what I'm doing, I'm currently on page 72. That's page 72 of your textbook. Right? So imagine his employment income this time was 14,200, and he had saving income of 2,500. Exactly the same scenario. Take off the 11,000, so that means that 3,200. So what we have, I'm just going to go down here. I've taken off the income, the personal allowance. So what I now have here is this 3,200, and then I have this 2,500. So let's deal with this first. This is sitting. Always deal with the non-savings first. This is sitting in the first 5,000 of taxable income, which means, if you like, 1,800 is left in that first 5,000. Of taxable income. So this will get taxed as normal at 20%, because that's just, if you like, what happens. He's got the personal allowance of 11,000. That's come off, if you like. So I'll just kind of build that up a little. 14,200. So you have this 3,200. This will be taxed at 20%, no problem. Then we have this 1,800 left, which can be used at 0%. To do with his savings income, but only 1,800 of it, and you can see there's 700 sort of that has to be dealt with, that will now be treated as normal under the rules for taxing savings income. Okay, great. And finally, the last example before we take a break, I try and make 10 minutes short, make them short at 10 minutes, so you can sort of prepare for the next one. Imagine his employment income was 30,000. So in this scenario, you can see that he will have no starting rate of 0%, just because the 19,000 he's going to have will totally just eclipse any 5,000 availability. There's nothing there, so you will just tax all this 19,000 at 20% as normal, and this 2,500 will be taxed at whatever the tax rates are when we look in the next couple of slides. Okay, right, great stuff. I'll pause the video there, and I will see you in the next video.